Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, September 13th, 2024. It's 4:03 p.m. Eastern Time, so the markets are now closed, and we ended the week exactly where I predicted we'd go when we began the week. So let's look at that. So this is the Nasdaq 100. We closed right on the primary downtrend line, as I highlighted throughout the day. And let's go to Monday. Monday was the 9th. Here's the chart I gave you. And there's arrows. So I'll give you green arrows, give you my thoughts. Long-term case, Bolton long-term bearish case continues to firm up. However, active traders can take a long here with a stop below Friday's lows for an objective attempt to game a bounce, and that's where the arrows had us going to the trend line. So like I said, we end the week where it looked like we were going to bounce to in the beginning of the week. So nothing more, nothing less than that. And that's the NASDAQ 100. I also gave you ES on Monday. That was the 9th. Same time, gave you a chart with some arrows, which I then added to the following day to show you that was the 10th on Tuesday. That's where we would go up to. So that, those dotted arrows, that's my max bounce target, which of course we hit. Like I said, that's a range to me, for me, scale back in short. And again, I'm favoring the NASDAQ 100. So again, that's where we started the week on ES, and let's go to where we ended the week. Boom, rally right into the trend line. So all right, guys, it doesn't get much more precise than that, but the $1,000,000 question is, or as I like to say, you're only as good as your last trade. Let's see where the next one goes, right? Where we're going to go from here. I've got one more for you. Haven't been covering it much lately because I haven't been trading it, but I'm going to get back to it. But here and there, I've had positions on and off, but my focus has been largely on the big caps right now because they're going to determine where the market goes. But you have your small caps too. Look at that, right into the same downtrend line off the highs, multiple reactions. And it's also that level I gave you a couple weeks back here, 2190, a significant level. It was this previous reaction high. We had a breakout, successful back test. Then we failed that back test. We went down. Then we took it out in a powerful pop. Successful back test, then failed it. This market's civil. It's it's multiple personalities, a little schizophrenic, but we also have just a dichotomy of what it is. It's a dichotomy of views. It's kind of like politics right now, and how divided they are. Out there, most people are either all for one party or all for the other. My opinion, we have the two worst candidates in the history. I think it's safe to say, without sounding like the guy that tends to embellish a lot, that in the history of our country, I don't think there's ever been a pair of worst candidates put up there. So we'll see what the elections have to bring. You guys have your own opinions, and I think they're both buffoons, and I think they're both going to be net bad for the country. But again, the good thing about that is it usually doesn't matter. President in the office really doesn't make much of a difference as long as Congress is keeping them in check. So we'll see what goes on there going forward. But all I can tell you in here, let me just not digress anymore. The big thing besides the election, of course, coming up, and we'll see what happens as we approach that time, is the Fed meeting next Wednesday. That's what the market's immediately focused on. This little rally here was it was a technically induced rally. Let's not add, there wasn't much more to say. We had, as I showed you at the beginning of the week on Monday, QQQ and SPY falling to not just support, but good support, positive divergences. You can see here, bullish falling wedge on RTY, and they all hit those trend lines. So if you think for any split second this is mere coincidence that you have all three of the big ones I track, the NASDAQ 100, the S&P 500, and the small caps all running into resistance and parking there at the same time, well, I think it's fair to say that's not mere coincidence. And now where we go from here, that'll be the big thing. So I shared my thoughts. I gave you a detailed post with thoughts, and on the end of that, I give you bullet points. And I can tell you that my plan. Anytime you have a big Fed meeting, and they're not all big. There's a lot. In fact, the majority of Fed meetings are the market knows what they're going to get. They know they're not going to get a rate cut or rate hike, or they're going to get one. It's well telegraphed by the Fed and priced in. This one, we know we're going to get a cut, but it's teeter-totter in between. We're going to get 25 and 50. And more importantly, the million or multi-trillion-dollar question is how much of that has been priced in. How much of a 25 or 50, or has the market not priced enough in? What I'm going to do in this video, we're going to start out as I've just done here with the charts, just to kind of follow through. It's not just the futures. I know you got a lot of ETF traders out there. There's QQQ. There's the same trend line right there. On Monday, I didn't give you a 50-minute chart of QQQ, but I did give you a day or two later, looks like on Wednesday, I gave you a 60-minute chart of QQQ. And same thing, the arrows, they were not ambiguous or, all over the place, or just go up here. Thought we'd get a reaction there. We didn't get much, if any. We went through, but we hit the final target. And so that's it. So this is the technical projection and most likely scenario that we'd get this week, and we got it. And the million-dollar question again, or multi-trillion, if you look at the stock market, where are we going to go from here? Okay, so I'm going to show you just a few more charts that I'm watching, and then if you are interested, I'll just do it'll be brief, but we're going to look at, I've been covering, I've been putting on my economist hat lately, and that's not my wheelhouse, not my forte. I am a business major. I am a former financial advisor and been, in that field for a long time, and do definitely apply fundamental analysis to my, my trading, especially longer-term investment, longer-term outlook of the markets, as well as technical analysis, which is charting. But I'm going to go over a few other charts that I find interesting and I haven't shared with you lately, and I'll do that towards the end of the video. Let me just show you what else I'm watching. So again, I can't overestimate or overemphasize, the importance of these levels. But on the flip side, like I said, with the Fed meeting coming up, how the Fed, the voting members, they have like a gag order. They go into that quiet period. I think, I don't know what it is, a week or two leading up to a actionable meeting. They have lame duck meetings where they're not going to do anything. And then they have the FOMC open market committee, which this is, where they're going to make a decision on whether to hold, raise, or cut rates. So, and they, those that have a say, they can't speak. So right now, I'm kind of going into this mode where I from experience, there's going to be volatility, noise, a lot of position squaring by big institutions. It's going to increase the odds of whipsaws. So my trading plan, I'm just sharing with you, is to sit tight. In other words, if come Monday they pop these trend lines, it's where I expected to go, and the reason the arrows stopped there and you never saw any additional arrows is because I don't think we're going to go higher. I think that was, and I think I made it very clear, the level to exit any last remaining longs and load back up for the next leg down short. You have my trading plan. It is like all my trading plans, it's fluid depending on what the charts do, but this is a level up here. This is the big level right here at about 45.68, and the comparable level on ES that I could easily see, especially in pre and post FOMC noise. That means FOMC is the Federal Open Market Committee. When they meet on Wednesday, that's certainly a possibility. And what I tend to do is just kind of allow, and again, it depends on each position, but widen up stops to minimize getting caught out in that, again, what I refer to as pre and post FOMC noise, because certainly Monday we're going to head into it. That's fine. We have a weekend now that we parked right on these lines, so we'll see what happens Monday. You know me, I'll convey my thoughts as we go. I just wanted to say that's it. And in an ideal world, if there was, what FOMC or not, in an ideal world, this is how it should play out. That's a rally into resistance. We're still well off the highs. I view this as the first major leg down, first big counter trend bounce. I mean, we gained this one too. Remember, covered that. I gave you those NQ charts and everything today. Then swung, reversed at the top, milked that little move there, milked that last leg down, reversed. Wish I could tell you I milked every penny of this to the upside, but that wasn't my plan. My plan was a hard reversal there, as I said. That means cover full short, all shorts, go full long, meaning not scaling in, and then milk most of that, and then scale out. And this is kind of what I'm scaling into here the last couple days back short. That's typically how I will enter a position. If I tell you otherwise, a hard reversal is just that. 100% closing the longs or short that I'm in, and then going the other way back to a full position. That's a hard reversal. Most of the time, it's or it just depends on the situation, soft in and out. So, and I'll give you those like scale in zones. All right, the other things I'm watching, as you know, are the financials. That was, and again, this is not mere coincidence. Look at that. There's the trend line. And look what happened today. Today, this is a 60-minute chart. 1, 2, 3, 4, 5, 6, 7 candles in a row. Now, as I like to say, resistance is resistance till let's get taken out. If they pop it out, you also have my trading plan. It's because it's an active short trade. Really, any pop above that trend line, ideally, doesn't guarantee anything, but ideally should be contained at about that 54.20 resistance level. So that's why I think your stop should be placed not too far above that. You don't want to put your stop right on resistance, because then if they hit it, they're going to pop you. And if you put it just a hair above, they take it. So what I usually do to avoid that, if you're in front of the computer, wait for a 60-minute or even a 120-minute close. If you can allow for it, a daily close is all the better. And then at the end of the day, you'll see this is what they do, they being the nefarious forces. The powers that be, whatever you want to call them, that's a body of a candle. You'll see there's your little skinny part, the wicks. Or here, I'll draw it better. That's what you get. You get the pop up through, they clear all the stops, and then boom, only to close the day back down below it and then see the downtrend resume. So that's why, be it whether you're long or short, you just ideally, I like to set my stops on using first and foremost ideal risk-reward ratios calculated based on my preferred price target or targets if I have multiple targets. So take that, and then from there I get that rough number, be it 2-to-1, 3-to-1, 4-to-1 risk-reward ratio. It varies on each trade, and then my stops will be placed tactically. So in other words, let's just say, for example, a 3-to-1 RR was going to have me stop out right here. I'm not going to put a stop just below resistance where if we pop, we're likely to reverse. I want my stop on the other side, just out of range of any potential stop raids are called. All righty, so that's XLF. And again, T2 is hit. Bounce to where I told you would be here to here would be your objective reshorting entry, and where ideally this would stop, anywhere back to T1. We took T1 out up to the trend line, and it's a very small range. It's not like, just like the range, we gave you on the recent levels on NQ and QQQ. We're only up another % or so from where we were a couple days ago. I've been talking about the reversal going back short last couple days, but it's a relatively small move. I'm trying to measure it, but you can see it's small. It's I got to grab right here so I don't move the line. 1.2% from that level to there. And so that's what I'll be watching next week. The other things, let's see, Nvidia, and that one is, I'll recognize what looks like possibly a bull flag pattern. So the one thing is, while stops will certainly be widened up for me in the next over the next week. Because you're going to see that volatility around the Fed. It can go either way. It's probably going to be both up and down kind of volatility, not just a straight pop up. Anything's possible. They give 50 basis points. Let me just say this, guys. This is where if you're new to this, and you don't know what you're doing, or you're somewhat risk adverse, you don't want to just tuck in and not have any stops, because this stock market could explode higher if they give 50 basis points, and that's the market's reaction is positive. You can get 50. I'm just going to give a wild guess. If they give a 50, you'll probably see an explosive pop which will probably either that day or within the next several sessions get faded, because when the the smart money comes out and say, "Uh-oh, what does the Fed see and know that I don't know? We don't know." Anyway, there's a potential bullish pennant, but nothing changes. Right now it's an untriggered pattern. If they do break, you want to see it impulsive, but this is still my scale in zone, scale back in zone. Remember, this was Nvidia highlighted. We've had many long, probably almost as many long trading ops as we have short, even though we gamed it. It's been a longer term swing short trade. These are targets that were hit with tradable bounces off each one. First target zone right here, and then broke it, went to the second target zone, bounced back to the first target zone, hit our third target, but we covered the hard reversal was that morning when we were down here. Highlighted that was long term. There's a long term uptrend line you don't see on the 60-minute chart. I've showed it to you repeatedly on the daily. We went long there, and then short on the downtrend line. So been calling this one with near impunity. There's that uptrend line, and we're still above the primary uptrend line, and so that's what needs to go. And there's that downtrend line, which we've yet to hit. If we get there at that time, best to take a look. What's everything else doing? What's S&P 500 doing? SPY, QQQ, the futures, the other semis. We'll talk on that real quick. Certainly worth watching. Remember, it wasn't just Nvidia that hit the primary uptrend line. The semiconductor sector, SOX, which is very heavy in Nvidia, did too. But you can see SOX, the semiconductor sector ETF, also parked at this downtrend line. So, I know it sounds like I'm beating a dead horse here, but this is important, because these are so many. The same thing in reverse happened on the morning of August 5th. And that's what, if you look at those posts, it wasn't one thing. I didn't just have SOX hitting my long-term price target, which was, long-term uptrend line, which was also a price target. I didn't just have Nvidia hitting it. I had, the NQ futures, QQQ, SPY, you name it, and everything else hitting or coming within their close proximity, their 200-day moving averages. This is that in reverse. We're now rallying up with so many important things. Again, not utilities or things that don't matter. The things that matter, the semis, the sectors themselves hitting trendline support. And if they break that, yes, it's absolutely a near-term bullish technical event. But you have, these are really this is kind of the line in the sand, in my opinion, for the semis, 242.02. That was a major level there. It was resistance. You had a breakout that proved to be a failed breakout, bearish engulfing candles, wedge break and back test. And then when that level failed, the semis got, they plunged and they hit support. So we're bouncing between support and resistance. We rallied back up, got rejected again, came back to the trend line again. And so that's a big level. I cannot spin a breakout above 242 as anything but bullish. And if it breaks out and fails again, then that's bearish, right? You follow me? So these are the levels to watch. Ideally, for the bearish scenario, would be a rejection here, and then super uber bearish if not only SOX, but all these, Nvidia, all these things lose that trend line support, and again, the recent lows from August 5th. That's kind of the lights out level for the market in many sectors. And right now we're above them. And a lot of things are, a lot of sectors and indexes successfully tested or briefly undercut, which is fine. I told you that's normal. We did it here. It's some things more than others. It's actually to be expected. When you look at the semis, they're very volatile. It's usually the S&P that'll come down and hit that level. There's less volatility and then bounce. But the point is, we hit it after just a couple days under it. We regained it. We had another brief undercut. We're right there right now. So this is it, guys. These are that's why I'm doing these videos quite frequently now, and they're pretty long-winded. There's a lot of key levels, and we'll see where we go next week, like I said. And then, again, I can't give advice. I'm not in that field anymore. I used to be registered as a registered investment advisor. I'd provide analysis. I tell you my 2 cents, what I see in the charts, objective trade levels, support resistance levels, trading ideas, and then it's your decision to take or pass on that, or incorporate that analysis with your own and that of others you follow. And I'm just telling you where these are big levels here. And And we have also, let's not forget, we had, and which is still my overriding factor as to why am I not positioning right now long for a breakout above that level, and then long for a breakout above there. Again, there's a lot of evidence to say that was a top, and we're still well below that top. These are the semis, the canary in the coal mine for the tech sector, and the tech sector being the most important sector in the market. We're still 16% off the highs. So we'll see where we go next week. A couple more for you, and then we can move on. Let's do one more chart, and then I'm gonna roll into the economic indicators that I want to show you. Really more so insight to the consumer. These are things that I don't know if they're being talked about anywhere, but I just want to share them with you. This is XRT. This is the retail sector ETF, kind of a tell on the economy. But remember, and this is important too, if you're new to this, you might not have heard this. If you've been in the financial markets for a while, you know that the stock market and the economy, although over the longer period of time, viewed in a large enough time horizon, they do have a correlation, but they are not one and the same. Absolutely not. The economy always turns first. It's hard to see. There's so many moving parts, and there's such lagged data, and that's one of the biggest problems. I've told you before, every single recession we've ever had, all the revisions come in after the fact. GDP, employment, they start revising them down, and then the NBER is going to tell you well after recession's underway, well after the stock market's already down 20, 30% or more, oh, hey, guess what? A recession started, last quarter, previous quarter. And so that's how it works. So we watch things like this for clues. Here's XRT. It's been in this trading range forever and a day. It's had several failed breakouts, and it's just kind of now, at this point, it's back into the trading range. That was a yellow line I had. But it's more so this trading range here, right? And this high was a divergent high right here, negative divergence. It really comes to about right here. No, I had it right. It was right here. That was a divergent high, but right now I'm going to color this. And that was T1. Remember, I predicted a failed breakout at the time, and I gave you a target here, and that target was hit. And these are still the other targets. Because as I said, typically when you, actually there's two highs there. This is the top of the range officially. Once you have a failed breakout on the top of a range, you're typically going back down to the bottom of the range. And that's that. Now, I'm going to color this up. You might want to set a price alert. 70.82, that's a big level right now. Actually, yeah, we'll just leave it there. 70.82. You can see that's the bottom of this recent range. It was resistance here. They popped it. Support, support, support. Now we're going to talk a little bit about the consumer. Let's go ahead and do that. I'm going to start here. This is just an article I read today, posted today, on how, just some U.S. indicators, how the economy could be heading into choppy waters and blah, 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 blah. These are things I've covered. U.S. manufacturing, PMI, and presidential elections. And they show you, oops, that's not what I want to see here. Let's grab a tool here. You can see, and it tells you here, we've been in manufacturing's in contraction mode. Anything under 50 is a contraction. We haven't seen that. They're showing you the last elections here, and you can see we've had now 2 consecutive readings under there of contraction. So manufacturing has already turned the corner and is in contractionary mode right now. You have the SOM rule, and that's one that even the Federal Reserve, the Fed website, which I'm about to take you into and show you a lot of my charts, that recently triggered, and that one has had a track record of successfully predicting the, where is it? Somewhere on here. Little known but accurate recession indicator that has predicted every recession since 1970. So pretty good track record, right? The yield curve inversion, talked about that. The yield curve inversion that just wouldn't quit. I remember I told you at the last FOMC meeting a month ago, you had Powell. I remember him coming out in his press conference and dismissing the yield curve, inverted yield curve, as a recession indicator, saying, oh yeah, everyone's talked about that, but that didn't work this time. Well, again, it's not the inversion, it's the uninversion. And this has been also one of the most reliable recession indicators over the last 50 years. And last week it turned positive again for the first time in over 2 years. I think I covered that for you yesterday in yesterday's video. An inverted yield curve. It goes on to say that this was the, before last week, the yield curve had been inverted for a staggering 783 consecutive days, the longest ever in U.S. history, right? But they go on to say that, the variance, sometimes it's inverted and then uninverts and the recession comes pretty quickly. But they go on to say too that, there's usually about a 12-month lag, but there's some variance there. And they go on to tell you, I've read through here, there was one, some of the periods were quite a bit longer than that. So this one just happened to be the longest. And now let me roll into my indicators from Fred. Got them right here. Okay, I've got all kinds of boards in here. We're going to look at different, a ton of charts saved, but we're just going to look at the consumer real quick, and then I'll wrap this up and let you get started with your weekend. And this one here, hopefully you can see these in the video. I don't think there's a way I can click and expand each chart, but that's just going to take a little longer. It's not my PC. It's Fred's website is slow to load. So let me just undo that. Oh, there it is. All right. So we'll just do this one here. This is, hopefully you can see in the video, the delinquency rate on credit card loans, all commercial banks. And this is as far back as they can go. All right. So let's just look at right now. So we had COVID here. Delinquency rates plunged. Because it was an unprecedented amount of fiscal and monetary stimulus. They shoved cash down consumers' faces. If you owned a business, I don't have to tell you, you won the lottery with PPP. If you didn't, everyone gets, the qualifications are so easy. Let's not even talk about the fraud, but everybody got money. Everybody I know down here in Southwest Florida was already having their best year, one of their best years to begin with. Florida, remember, we never really shut down in COVID because of our governor. We kept booming. Construction was booming. Growth was booming down here. And people I know were just getting anywhere from, hundreds of thousands of dollars if you just ran a small business. And it was, not fraud qualifications. You show us 1 quarter over the previous. And then, of course, everybody got checked. So let's just forget about the small business owners or large businesses, too. The PPP hit. We all know that everybody got checks. Well, everybody that, under a certain income level, which is most people. And so, yes, the banks were told, cease and desist on, there were all the mortgage forbearances and all that. So obviously you saw the lowest trough there, but you can see the trend coming up here, and you can see at every economic expansion, these gray areas are recessions, there's a trough. Once the trough happens, you turn the corner. It's not a timing indicator, but you don't have to be an expert chart technician to see once credit card delinquencies change, a trend change has occurred that is, at least historically, has been, that's it. There's really no variance. You get a little, and then invariably the recession starts, right? And you can see it's usually, and it takes a while. It's not an exact timing indicator, but it takes at least a year or two. There was the last one there, had a little hiccup, and then boom, then the recession came. So there's the financial crisis. There's the dot-com bubble. There's COVID, and somewhere over to the right here is the next recession. All right, let me go through the rest a little quicker. All right, so that was the delinquency rate on credit card loans for all commercial banks. This one's even more interesting. You know what? I'm going to expand it just because. I realize I can just pause the video while these slow loading charts load. Again, as far back as it goes, but so these are the same thing, delinquency rate on credit card loans, but banks not among the 100 largest. And so these are the ones where, the regional banking system utterly collapsed. We had the biggest bailouts, 2 of the 3 largest bank bailouts in history, and they were regional banks, and they were what were deemed not too big to fail banks. But then all of a sudden, retroactively, the Fed said, we screwed up. And guess what? A lot of these, we don't realize the systemic importance, and they are too big to fail, so we're going to bail them out. And so, that's occurred, and they've been supporting them since. But look at the trend here. So these are, again, I don't know if specifically if they're going to be all regionals, but I'm going to guess if they're not among the 100 largest, that's probably going to fall down to the regionals. And again, just study this chart. Look what's happened. So not only are we at, have we turned the corner? This is the highest. We're going back to the beginning of the 90s right here. Look at this trend. I don't know why these things aren't being talked about. And the banks are just, they're able to, in a lot of cases, fudge the numbers, as we know that. Nothing's changed since the financial crisis, where the banks were cooking the books, hiding losses, using mark to fantasy, which is the nickname for mark to market accounting. And anyways, that's just keep in mind this. You're not. It's unlikely that this inflection point will not be followed by a recession. This is alarming, in my opinion. Here's where we were before COVID. There was our last recession. There was the inflection point in 2006. That's when I think I erroneously stated that the housing market peaked in 2005 in my last video. I remember right after saying that, thinking, I remember it being 2006. It was 2 years before the financial crisis started. Remember, the stock market peaked in October of 2007, but then the real plunge came in 2008. But again, these things, that's when it happens. It happens that happened the trough 2 years before. We had the great recession, one of the worst financial crises and one of the worst bear markets in history. Back in 2000, you had the dot-com bubble, and then a recession followed there. So you can see the turn right there. We had a similar, a lot of stock market volatility and weakness and near recession back in the 90s there. But either way, I just wanted to share this chart with you. These are the things that I look at. So here's so those are the delinquency rates. And then here's on the larger banks, it looks a little better, obviously, but still trending up. The trend, the trough is in, the turn is in. Large bank consumer credit balances. Large bank consumer credit balances 30 or more days past due. Look at this. That's a pretty interesting chart right here. Again, these go back as far as the data goes. I wish I could go back farther. Look where we're at now. We're well above COVID levels from where we're at the last recession. This has just been climbing steadily. That's beyond. These are credit card balances 30 days past due. And then look at when you go to 90 days. Wow. It's surging and it's trending up, and there's no variance here. It's no leveling out. Large bank consumer credit card new origination. So the large banks are cutting back. They're finally hitting their threshold, and they're started to cut back on new credit card issuance. Charge-off rate on credit card loans, all commercial banks. So they can sit on those losses, pretend and extend for a while. At some point, they have to recognize those losses that people that aren't paying back the credit cards, and they're starting to finally charge off. And so you can see the turn there. You're over the previous peak. There was a turn there. There came the recession. There was a turn there. There came the recession. And then when the recession starts, these it's just they start charging off. They get a lot of, they can purge their books. The market's dropping. They're going to get a pass from the Fed and from, everyone else. It's the recession's fault, not our fault. And so that's when they really start charging off those loans. But you can see the trend. And again, guys, these are unmistakable trends. And they're not, I'm not pointing out these little, micro, trends and zigs and zags back within. I'm pointing out the inflection points that typically come before the recession right there. This is, again, same thing. Charge-offs on credit cards on banks ranked first to 100th largest in size. So you have JP Morgan Chase first, and then all the 99 others behind it. Balance sheet. Look at this. This is the consumer, guys. This is just my consumers folder of charts from Fred, which is, again, St. Louis Fed, a Federal Reserve. Balance sheet, total assets, loans to individuals, credit cards. This ain't going to end well. This is, oh, you can't see the year breaks here. All right, so here's where we were back in, the financial crisis was dubbed also the, a debt bubble. It was some call it the housing crisis, but it was a widely acknowledged as just a general all-out everything debt bubble, excessive debt. And how do you cure, a hangover, a debt hangover? With more debt. Just like the alcoholic wakes up and that's Harold the dog, another more alcohol to stave off that hangover. And so debt exploded because the Fed allowed it. Fed went to a zero interest rate policy and created more wanton and reckless behavior and kept it that way. There's COVID, took it down again. COVID, you saw loans, cut down and then another explosion. So, anyway, there's no boundaries on this. Over time, you will expect credit card debt to increase as there are more and more people on this planet, more and more people in this country, at least as a U.S. chart, and money also being worth less due to inflation. So, however, there's your general trend. If you want to take a trend line of a median of what growth should look like over time in credit card debt. And so you always get mean reversions, and this reversion is going to be ugly. And when you mean revert, you tend not to come back to the trend line on bubbles and excesses like this. You overshoot, and then you come back up. So, anywho, take that, check it out. These charts, you can. This is free information from the St. Louis Federal Reserve. This is stuff that. Again, I don't watch CNBC. I only turn it on or Bloomberg just to catch, when there's a big market moving event like a Fed. But when I do, and you're on, I'm waiting for that. They do march out the so-called experts, and maybe there's some talking about these things. But to me, the evidence is just glaring. And then I'm going to end it at this. I've said this before. I've said it earlier in this video. Remember, the stock market and the economy are not one and the same. So all this is doing, I don't trade based off this. In fact, you know me, I was long going into the week, right? Based on everything I started the video at. So the charts are going to tell me to position long or short and catch these little ups and downs within. But I do think this helps to project where we are in the cycle. Because it seems most right now, most of the big firms and the quote unquote leading economists are still in that soft landing camp to no landing, and this to me is screaming pretty ugly recession coming up relatively soon. And then the last and final takeaway: when you see distortions like this, things that aren't being priced into the market. Because folks are looking at, again, they're looking at the current, and which is pretty much lagged employment data, saying unemployment's at record lows right now. That's what you keep hearing. That's the strongest pillar of the bull case. And as long as the job market's strong, the consumer has a job, they're spending money. Okay, why? I want to just find one of those people and just ask them, why on God's green earth are we seeing delinquencies surging right now on credit cards? Why aren't people paying off all of a sudden if everybody's got a job and the consumer's hunky-dory and they're spending all right? I'll tell you what they're spending. They're spending on their credit card. They burn through their cash. That's why credit card debt's soaring. And that was working great. And that's why we had the delay. That's why, believe me, I was in the camp a year and a half ago when they started raising rates. The recession would already be here. And like many, that was the consensus. It never came, and so now a lot of folks are saying, oh, well, wow, the market was able to absorb the biggest rate cuts cycle in almost half a century, so I guess that we're bulletproof now. Nothing's going to break the market. Consumer strong. Again, that was just the lag effect, and that spending, it's evidenced by these charts, tell you that at some point along the way, and it wasn't a single point, it was a moving number, all that stimulus cash that was injected into the consumer's pocket had dried up. It was drying up, and they kept the spending going. And there's all kinds of articles out there about doom spending by the millennials, for example, that have resigned themselves to the fact they'll never be able to afford a house, so they're out there buying watches and taking trips and traveling and all that, and not worrying about saving for retirement and a home, because it's just never going to happen. And so this credit has fueled, and it's fine as long as people have the means to pay off their credit cards. But what this shows us here, these charts, the delinquencies, past due, 30 days, 90 days, banks starting to write off those the unpaid credit card debts. That shows you that now that everything's dried up, and anything short of major stimulus, which I would be shocked if we didn't get it, before or after the next election. But again, the ship appears to be turning in the economy, and in some cases, the stock market. It doesn't turn, especially the economy never turns on a dime. You don't see the COVID was a one exception, but because they government forced a shutdown across the world. But usually it's a slower roll on the economy. It's like a super tanker out at sea making a turn. They don't turn like a speedboat. It's a slow roll. And like I said, all the charts to me that matter, the ones that aren't subject to revision, these aren't subject to revision charts. These are actual reporting. They're not based on some quirky, extremely flawed birth-death model like the jobs number, which just uses some hypothetical made-up formula based on their guess of immigration flows and all this. All right, I'm going to stop it here, guys, get it out to you, and we'll see where to pick the week up. Remember, we closed right on those bounce targets, right on the trend lines, and we'll see how we trade Monday, Tuesday. I'm not going to read too much into anything that happens. Wednesday, it's going to be fireworks, one way or the other, or both. And then, unfortunately, it's going to be towards the end of the week, maybe even next week, before the dust settles and the market is fully priced in what the rate cuts that we got on Wednesday, or we're going to get on Wednesday, are going to mean going forward. This has been Randy Finney with Right Side of the Chart. Have a great weekend.